Ladies and gentlemen, good afternoon and welcome to our Bellevue Chamber Economic Outlook. It's great to have so many folks with you and registered today. We've got well over 400 that registered in the beginning, and of course more that will be joining us on Facebook Live and by telephone. So this is just a great opportunity to talk to so many of you about such an important issue. My name is Joe Fain. I'm the CEO and president of the Bellevue Chamber, and it's just been a lot of fun hosting these webcasts over the last week and a half. This is episode number 4, and we've got a whole bunch more in store that we'll tell you about later on. In the past, we've had the deputy director from the SBA, the chair of the King County Council, the mayor of Bellevue, some of our top legislative leaders. So we're really trying to provide unique access for you to ask your questions and come up close and personal with some of the decision makers and the individuals that really know what's going on in the community and certainly in the economy. I want to remind everyone that questions are what make this thing so special. And so on the bottom of your screen, you've got this Q&A button. I hope that you will use this to ask as many questions as you'd like. Doing this, we'll be selecting some of the ones that get upvoted and sending them over for our experts to answer. So that's a great opportunity for us to get real-time feedback from our guests here today. In addition, we also have several poll questions that we'll be asking because we want your feedback on what you're thinking about for your business, your employees, your family economics. We really need to know how you're faring through this very unique time. And to help us get started here today, I want to introduce a friend of mine and a board member of the Bellevue Chamber, Bruce Munster. Bruce is a principal at the Munster Freeman Group, an M&A focused advisory practice in private banking for Merrill Lynch here in Bellevue and in Los Angeles. He's got a lot of experience advising high net worth individuals on where the economy is headed. And I want to kick it over to him and welcome him today. Bruce, how's the market faring today?
I'm going to start with a tough one, huh? Well, look, thank you, Joe, for the introduction. Thank you all for joining us on the call today. And look, no doubt it's an unprecedented time. The world seems to have changed overnight. Our primary concern through this time has really been the well-being of our families and our teammates, our clients, and more broadly, the community. And so like most of you on the call today, I'm working from home. I've been doing this now for almost a month. And most of my team now has been working remotely for about 2 weeks. And so we've made the adjustment. More broadly, was interested to learn that as of last week, we had 150,000 Bank of America and Merrill teammates all working from home. So I can only imagine the operational challenge that was to coordinate all of it. So the impact of the health crisis, an economic crisis here is still unfolding, and we'll learn a lot certainly about the economic side and the impact on markets, and I'm thrilled to have my esteemed colleagues join me today. But I wanted to take a moment just to talk about some of the things that Bank of America is doing in this really unique time. We've heard quite a bit about public-private partnerships and how corporate America is stepping up to face this challenge, and BofA is certainly stepping up to do our part as well. So to date, BofA has pledged $100 million to address some of the most desperate areas of need. So equipment and resources to our first responders and healthcare workers, access to remote learning in response to school closures, and food insecurity, just to name a few. And as of last Friday, our CEO, Brian Moynihan, shared that we had already processed 150,000 requests for mortgage forbearance. Loads more credit card and auto forbearances, small business deferrals, whatever we need to do to help our customers in this time, we really want to be there. And like a lot of companies, we made the pledge not to lay off employees, and we took it a little further. We actually added 3,000 teammates in the month of March. We've also wanted to be there for our clients, and so we've lent out more than $50 billion in the month of March. My colleagues and I are putting in 12 and 14-hour days to help our clients through this extraordinary time, and weekends are feeling a lot like regular work days now, but we'll get through this. This crisis, it certainly is bringing us together, and so I'm delighted to share this time with you and share our best economic and market insights in the hope that each of you are better prepared for the tough road ahead.
Thanks, Bruce, and thanks for putting us on today and getting us some of these great speakers and panelists that we have to share with our group here today. And I want to introduce the first one here and share her here with the rest of you. Michelle Meyer is the Managing Director and Senior U.S. Economist of Bank of America Merrill Lynch Global Research. She's the primary fixed income trading floor economist and a specialist in the U.S. housing market, which is particularly interesting as we've seen maybe some counter-cyclical or counter-market moves in some parts in the housing market, maybe a little slow to catch up. So we'll look forward to hearing from Michelle on that. Michelle, what are you feeling on the street, and what are your insights?
Sure. Hi, everyone, and thank you for having me. And I echo the view that I hope everybody's staying healthy and safe during these times. So we're tasked, of course, with trying to figure out how this, global health issue, how the COVID pandemic is impacting the economy. And the reality is that it is quite severe. This is a shock unlike anything we've seen in the past. We are seeing, as a reaction to the pandemic, we're seeing governments effectively shut down parts of the economy. So the way to think about it is if parts of the economy went into hibernation or even more severe, an induced coma, and it's all happening suddenly. So, the economy, we think, turned into a recession in the middle of March. The second half of March, the daily data that we look at from our own card spending data or from our consumer sentiment monitors, just to understand the pulse of the economy, shows that there was a decisive turn down in the second half of March. We saw similar data from the jobless claims numbers. The number of people who filed for unemployment insurance last week was at a staggering 3.3 million. We think we're going to see 5.5 million people file for unemployment insurance this week, and the numbers will remain high for a while, given what we've heard from states that have reported capacity issues in terms of being able to process all these jobless claims. So parts of the economy have shut down as a result of these lockdown efforts. That's a severe drop in economic activity between March and April. And by our baseline assumption, we think we will see double-digit decline on an annualized basis in the economy in the second quarter. We're forecasting currently a 12% decline. That would be a record in post-war history for any given quarter. And I think the risks are very much skewed to the idea that it could be even bigger. Trying to estimate the impact to the economy from these lockdown measures is doable. We can look at the sectors that are being shut down. We can determine the loss of economic activity. We can determine how many people might be impacted by that. But I think really the big question, and what we're all trying to understand in markets and economists across the country, is what is the risk that this shock multiplies and it persists and it ends up being something much bigger and deeper and harder to get out of? And I would argue that the way that would happen is if you get an adverse feedback loop develop where, the COVID pandemic, the health crisis leads to this shutdown, which forces people out of work, businesses to close. Those people don't have income to rely on. And if they do, they're more inclined to save it. So they're not putting that money into the economy. That then ripples more broadly to other industries that are not necessarily on the front lines of the COVID pandemic. They have to close doors, more layoffs, more income destruction, and more pain, which is then amplified by challenges in the financial system, right, in terms of, defaults and access to credit and the like. And I think what I've been encouraged by is that the way to prevent that adverse feedback loop, or at least slow it, is from a very aggressive and targeted policy response. And here I would argue is that we've seen that, and that is something that stands out a bit from the great financial crisis in 2008, where policy ultimately came to the rescue and stepped in a significant way, but it took time. The Fed had to write a whole new playbook. They had to figure out how to implement these lender and buyer of last resort type policies. Washington had to figure out how to bail out industries that were impacted. They have those playbooks now, right? And immediately the Fed stepped in with aggressive action. The Fed brought interest rates to zero. They've expanded their balance sheet tremendously with an unlimited quantitative easing program. So just in the past week, the Fed expanded their balance sheet by $1 trillion. By the end of the year, we can easily see the Fed's balance sheet double from where it was pre-COVID levels. It could be, in the order of $9 trillion. So they're buying agency treasuries, they're buying treasuries, they're buying agency MBS, and they're doing so to support liquidity in the treasury market, and it's helping. They've also put in place a number of other funding facilities and liquidity measures as a way of providing market stability. So all of that has been quite impactful, and it's early, and it's targeted, and it's aggressive. We saw the CARES Act passed by Washington. That's over $2 trillion of stimulus that's also targeted, trying to help those individuals that are most impacted by COVID in terms of providing unemployment insurance, expanded benefits, stimulus checks, and also, very importantly, trying to distribute funds to small and medium-sized businesses that are in a tough economic position and trying to keep their doors open and keep workers employed as long as possible. So it will take time for the fiscal program to kick in. Monetary policy is more of a blunt instrument, but it happens immediately. It's very quick to implement for the most part. But fiscal policies take more time, but they're there. So I think that does help to prevent what could have been otherwise a much more prolonged and deep recession. So, the shutting of the economy that's happening, that's a big shock. But I do think that if we can get to the other side of this, if the virus ends up proving to be contained, if we start to see the quote unquote flattening of the curve in terms of the spread of the virus, we can start talking about how the economy comes back to life. I think it will be slow. There will be bumps along the way, and there'll be parts of the economy that may never come back to what it looked like prior to COVID. But a recovery will be upon us, I think, and that is the key. And I think a lot of it rests on this stimulus response. So perhaps I'll stop there and turn back over to you.
Michelle, thank you. Those are great thoughts, and certainly, as we've seen, really unprecedented action out of Washington, D.C. A lot of us are asking those continuous questions. Is it enough? Is it timely? What are the long-term implications of the debt that's bringing on to the taxpayers? And certainly a lot more great issues that we can dive into during the next 45 minutes. I also want to welcome our next guest, who is Michael Hartnett. He's the Chief Investment Strategist for Bank of America Merrill Lynch, and he is a widely celebrated economic strategist around the globe, a former Director of European Equity Strategy in London, and has been based in New York since 2004. Michael, thanks so much for being with us.
Great, thank you for having me, Jay.
So what's your take on the current situation, and are we seeing enough action out of regulators in Washington, D.C. and out of Congress?
Well, I think there's sort of three ways of answering that. I think number one is, there's the macro, there's the markets, there's Wall Street, but there's also, the health of human beings. And, it's very difficult to arrest the sort of spiral downward that you're seeing in terms of asset prices and economic confidence and employment and asset prices. It's very difficult to arrest that, downward spiral until we know that the worst is past so far as the health crisis. And, people will use the coronavirus cases and, deaths, unfortunately, as a symbol of that. So, we're all waiting for the curve to flatten before, you can, with great confidence, make statements about, what the economy is going to do and what the markets are going to do. I think the second point I'd make just on the policy side is, echoing what Michelle has said. I mean, you are seeing a really big policy response. Now, let's be clear here. This follows a crash in the financial markets that rivals '87 or 1929. I mean, if you look at the peak to trough decline that we saw in March, Joe, in global equity market cap, I mean, we're talking $25 trillion. I mean, that's, the Chinese and the European economies put together. So you've seen an almighty, decline in market cap already. And I think, as Michelle it has explained, you're likely in the second quarter to also see a drop in economic income and spending that will also be very much in the trillions. So, I don't want to sort of sugarcoat this in any way, but the good news is that the initial, so we call it the first phase of policy response, has been very, very good. I think the Fed, bar buying equities or arranging with other central banks to officially reduce the value of the dollar, it's difficult to see what else they could have done at this particular stage. And I think that the fiscal policy lags and perhaps is less immediately impactful, but at least in the US you've seen a response there, and you toss up those numbers of what's coming down the tracks in terms of stimulus. We're talking globally $7 to $8 trillion of quantitative easing, which is the central banks purchasing fixed income assets and other financial assets, and you've got you add up all the fiscal stimulus, it's probably, we're talking 4 to 5 trillion already, and that figure undoubtedly will grow. So I think you've got the health policy issue, number one. The second point is you have had a big policy response. What I would say, however, is that it's worked for the best, highest quality parts of Wall Street. What you can see, which you couldn't see 2 weeks ago, Joe, was that companies are now able to issue debt. Investors are choosy with regards to price and collateral and all of these things, but the credit markets are open. You're getting deals, done. There is no longer a credit crunch. You're seeing within Wall Street the corporate bond prices have rallied significantly, and if you like, the liquidity risk has, I wouldn't say vanished, but certainly has been alleviated, greatly. And that has to happen. It's an important first step. It has happened. I think the problem is that while the policy thus far has hopefully ended the credit crunch on Wall Street, what it clearly hasn't done is end the recession on Main Street. And, I think what we need to wait for is, as I said, the health issue, the lockdowns. I mean, obviously those things need to end, and that will take a period of 6 to 12 weeks. And in the meantime, you need to see effectively the government replace the private sector in terms of lost demand, and thereafter you're going to need to see that stimulus generate confidence that in the second half of this year and in 2021, you start to replace the lost earnings, the lost employment, the lost economic growth that clearly we're all going to suffer. And I think that right now in the markets, what the markets are kind of telling you is that, I think, the worst of the credit crunch is over, and, if it stirs again, they'll probably do more. And so what you're seeing is people say, I'm confident about corporate bonds, but if you like, they're not yet confident about corporate equities, and they're not confident about corporate equities because needless to say, equities are more cyclical. They're more, driven by sort of profits, and everyone knows that situation is a lot tougher. So, just to put it in sort of broad numbers, what I get from clients in Europe, in Asia, in the US, the broad sort of consensus at the moment is, look, there's not a lot to do, between 2,300 and 2,600, 2,700 on the S&P. If it gets to 26, 27, I'm going to take money out of the market, and if it gets to 21, 2,200, I'm going to put some money back into the market. But right now, it's if you like, Joe, a big fat trading range with a lot of volatility, and that's really going to continue until people can leave their homes and start living a normal life again.
Thank you, Michael. And, it's interesting because this situation isn't a result of maybe bad fiscal policy necessarily, or a result of slowing consumer confidence. It really is a hyper-focused response to a very specific threat, which means, of course, that there are going to be a lot of industries and sectors that are capable of capitalizing on it. So, not that I'm asking you to be a stock picker right now, but where do we see the growth opportunities in the market because of the change in lifestyle and the way that we're having to work and live these days?
Yes, I mean, I think that there's sort of three, if you can visualize it, that there are, certain companies, there are certain sectors that perhaps will suffer a permanent loss of business. There are other sectors and companies that will suffer a temporary loss of business. And then, here we are on a Zoom, communication, network and conference call. And there are obviously certain businesses like Zoom that will gain enormously from, a new way of living, a new way of working. I think very broadly, Joe, I would say that where people see, the sectors that people see, or put it another way to you, what people are looking for in terms of the assets that they want to own right now is, as you rightly say, two sort of characteristics: growth and quality. The ideal asset that you own is one that can grow their earnings in 2020, 21, 22 in a period of great uncertainty, and I think that those types of companies will be in technology, they'll be in healthcare, they'll be in biotechnology, and as always in times of uncertainty, they'll tend to be in consumer, staples, too. So what's interesting, Joe, just to let you know, is obviously as an investment strategist, you have to follow what people are buying and selling. And what we've seen year to date, it goes without saying, is a tremendous amount of selling. But there hasn't been, of everything, but there hasn't been 1 week this year, not 1 week this year, that people have sold tech companies. That there have been inflows into tech funds every week this year. And in fact, this week, it's the largest inflow of the year. So clearly the market is saying, if I'm going to go somewhere, it's going to be in tech, it's going to be in healthcare, it's going to be in biotech, it's going to be consumer staples. And again, we can drill down, further if you need to. Certainly any technology that allows you to improve, the quantity, quality, and reduce the price of education and health, without saying, I mean, they are big, big winners, going forward. But I think the other angle is the quality angle, is that there is, and you can see this very decisively in the corporate bond market. People are saying, I can go back and own the corporate bond of an investment grade company because it's a high quality company, it's got a good balance sheet, it's got a good franchise, it's got a good product, it's got a good management. But what you're not seeing is people willing to go back to what are described as high yield bonds or more distressed cyclical areas of the corporate bond market. So growth and quality are really the two touchstones right now in terms of sort of, using cash, and putting it back into sort of financial assets.
Thank you, Michael. Michelle, I got a question about the employment situation. We just did a poll out there that folks are still participating in, and ask if individuals have had to lay off or furlough any of their employees. And fortunately, right now, the responses that we're getting are relatively high. About 73% of our respondents have said that they've retained all of their employees. And we've seen that in circumstances outside of the service sector. Michelle, tell me, how long can we expect companies to hold on to their employees, especially outside of some of these booming industries? And then probably equally as importantly, how often can we expect the federal government to step in with greater and greater leniency on unemployment benefits?
Sure. So it's interesting that layoffs, by your calculations, have not happened in a significant way, because in the aggregate numbers, unfortunately, it looks like you are seeing quite a lot of of cuts and reductions. The best way to proxy that is from looking at weekly jobless claims figures. So last week there was 3.3 million people who filed. We'll get tomorrow's numbers for next week, for this week. We think it could be in the order of 5.5 million. So you've seen certainly a number of big companies talk about furloughs, some job cuts, like, publicly, for example, Macy's, Marriott. But then you have a whole lot of smaller and medium-sized companies that the math just doesn't work in terms of being able to keep their workforce when their doors have been shut. So unfortunately, I do think that the job cuts are going to be quite substantial, in the order of many, millions. You can see, between 10 and 15 million people lose their jobs over the next 2 months. The hope is that it will prove to be temporary, that once we get the virus contained, the economy opens again, these people will be employable, they will get back to work, and they will do so somewhat seamlessly. I think more likely there will be some frictions, especially if you're in the industries that have been hit the hardest, like the travel-related industry. It might be a bit hard to be able to forecast, a return to normal where you need a fully staffed company, so you might be a little bit hesitant. So I think there will be some frictions. I think there will be some residual damage, but there will be a big increase in employment once this comes back. Because again, it's all in a sense an artificial adjustment, right? A lot of these companies were mandated to close, and people are sheltering at home. Once they come back into the economy and they're active again, they'll need workers. And so you will see a big jump at some point in the summer. But in the meantime, the numbers are going to look quite scary in terms of job cuts. To your second point about the automatic stabilizers of unemployment insurance, so the good news is that there are automatic stabilizers. These people who are filing for jobless claims or losing their jobs are eligible for support. The CARES Act has expanded eligibility. So gig workers, for example, who previously were not eligible to receive unemployment insurance now can. So it's a larger universe. Self-employed, so Uber drivers, for example. It also increases the duration of benefits. People will have unemployment insurance longer, so hopefully that gets them through this period. And they will receive more, an average of another $600 a week. So that all helps. I do very much believe that if this recession lasts longer and is deeper, the unemployment benefits will be expanded. We have precedent for that. If you look back to the 2008 recession, you saw unemployment insurance expanded to as much as 99 weeks, depending on the state. So in the states that had the deepest downturn, the highest unemployment rates, their unemployment insurance was available for longer. So the unemployment insurance programs are well-defined. They've been around for a long time. And again, they're just a nice automatic stabilizer that can kick in very quickly and efficiently.
Staying with you for a moment, Michelle, we've got a lot of questions that have come in on the housing market, and particularly we know that the 2008 downturn was in largely a result from mortgage-backed securities and increased foreclosures. There's a lot of regulation in place in a lot of jurisdictions, cities and states that have halted foreclosures, but with high unemployment rates, we know that the inability to pay mortgages comes through. How does that ripple through the economy over time? And also, what are we seeing with home sales right now? Is it falling off a cliff, or is it holding on regionally?
Yeah, so I think to the first point, housing is one of the more cyclical sectors. It also is a sector that has a lot of debt, so it's sensitive to financing, to the flow of credit, to the level of interest rates, borrowing costs. So it's important to monitor. So what are we seeing? So I think the first observation is that we're heading into this recession in a very different place for housing than we did in 2008. In 2008, housing was the epicenter. We had excess leverage and a whole lot to, excess housing supply. The housing stock was well and out of balance, way too many homes relative to the demand. So all of that corrected, and we're now at a state where inventory is still very low. Housing stock never fully recovered. We didn't overbuild. We didn't overborrow. We under borrowed and built. So there's not much to cut. So I think what we'll end up seeing is that there will be some pain There will be some adjustments, some reduction in construction, certainly a reduction in housing turnover. And I think home sales in particular are vulnerable because of people sheltering at home. They're not necessarily willing to have open houses or to have people go out and search for new homes and the like. So there's certainly some real obstacles there. So I think there will be weakness in housing in the next quarter or two. But I don't think it'll be excessive. And I do think that once the economy comes back, there will be an ability and a willingness to build again and to purchase new homes. But it will take some time. The other interesting question will be, do you start to see preferences switch again? I mean, after the 2008 recession, we had some pretty significant changes in how people viewed homeownership and renting. People became much more inclined to be renters, to live in city centers. That could change. I mean, there's always these kind of more structural stories coming out of recessions. And I think with COVID, I mean, if there's a vaccine, if it's fully contained, I think people will kind of move on and forget to some extent. But if there's still a threat of a spread of the virus, I think if memories are still pretty deep, if you lived in New York City through this, you may not want to stay in New York City. You may think a little bit differently about city living in close confinements versus moving out and having more space. So that's another question I think will be up there in terms of how people view renting versus homeownership, city living versus suburbia living.
Thank you, Michelle. Bruce, I want to turn to you briefly because you are boots on the ground, talking every day with the clients that you represent and advise. What advice are you giving them right now, and what direction are you pointing them in?
Sure. Thanks, Joe. A lot of it starts with financial wellness, making sure that they're well, their families are well, and some of them have had family members get laid off, and there's positive, productive ways to help them. And clients that own companies each have their own unique challenges. As they highlighted, some are seeing a temporary adjustment. Some may see a more permanent adjustment here, but really focusing on the liquidity needs that they may have and the continuity, and ultimately where there may be opportunities. And, one opportunity clearly is that many companies are going to have the opportunity to hire away some really talented people. But, the market-related perspective and insight we're sharing is really helping people to look through to, when we get across the canyon, we get to 2022, we have faith in science. We're going to beat this disease. There'll be an antiviral, then a vaccine. And so, when we get to 22, what is the new normal? And as my colleague Michael highlighted, we're focused on high quality companies that have the ability to continue to grow. And that really is a safe place to start. We're also, for clients that are more nervous about the health crisis, and then of course the knock-on effects of this economic crisis, is to help them understand that we're not likely to go to another depression. And it just does not seem to be a possibility. And when we can compare and contrast this time with the 30s, what we saw then was thousands of banks failed, and that doesn't seem to be a risk today. We saw a massive drop in the money supply, more than a 30% contraction in the money supply. And that certainly is not the case today when, we're talking about the Fed expanding so massively, as Michelle highlighted. And then finally, at that time, they tried to balance their budget. And we're clearly, with the $2 trillion CARES Act and more fiscal support likely to follow, we're clearly not going that direction. So our clients are principally focused on this just generational opportunity to buy assets cheaply. And fortunately, we came into this as well prepared as anyone. And so our conversations are very focused about, what to buy and when.
Thanks, Bruce. Your comment about not walking down the path of balanced budgets certainly serves up my next question for Michael, which is, of course, the national debt in 2005 was just a hair under 8 trillion. We're looking at it a hair over 23 trillion right now, I believe. What is the impact on the broader economy of that level of deficit spending, of that level of debt? And how are we looking over in the European markets where similar stimulus packages are pushing pressure on their central banks?
Yes. Number one, the budget deficit numbers both in the US, Europe, and of course Japan are extraordinarily high, and they will get higher. I think that can be a good thing, in the immediate future, because if you adhere to, Maynard Keynes's, view of economics, the government can and should step in when there is an exogenous shock or a deep recession, and try, in the famous words of Keynes, to revive the animal spirits of both, consumers and corporations. Obviously, that's very difficult to do right now when, everyone is inside worried about, a health crisis. But nonetheless, that is the job of the government, and the bigger, the bolder, and more coordinated their effort in the near term is, the more likely we don't have to worry about the size of the deficit, because after all, you'll end up getting stronger growth in 21, 22, 23 that will deliver revenues that will make the deficit go back down. So I think, it's a sort of on the one hand, on the other hand answer. On the one hand, there is extraordinary utility with what governments are doing and budget deficits expanding. However, at the end of the day, you still have to pay, the money back. And the worry, I think, for the US is that, and I think Bruce is absolutely right, I think that the Fed, the monetary backdrop, the FDIC insurance, the gold standard, these are very different things today compared to 1928, 29. I don't think you're going to get a Great Depression. However, the monstrous size of the budget deficit, the one thing that it can have an impact on is the US dollar, because the US is now a debtor country. And so the one thing you slightly worry about with the size of the budget deficit and is, particularly in the US, is that it could lead to a loss of faith globally in the US dollar. And obviously, if you've got a situation where the dollar was falling, because of fears that the Americans would not be able to repay their debts, and at the same time Treasury yields were rising, that is not a comfortable place for either the economy or the financial market. So it's a delicate balance. Yes, you've got to create the belief that the government can step in. Michelle was talking about sort of unemployment benefits. I mean, this is terrifically important at stabilizing and maybe improving animal spirits. At the same time, however, you have to give a belief to the market that over the longer term, we're not going to be spending like drunken sailors for the next 10 years, because, someone's going to have to pay for that. And of course, I can only speak for myself. I'm 53, but the balance sheet that we're leaving for our children, is a rather sobering one, I think, when you think about where we'll all be in a couple of years, I fear.
So when we're talking about dollar valuations, and we're often talking about it in terms of relative stature to the yuan or the yuan or the yen. Yeah. I can see as we move in parallel to their actions, that's one thing. But an interesting question came in a moment ago about the role of cryptocurrency, and your comment about this is all about propping up the faith of our government's ability to respond to these situations. And in many cases, cryptocurrency is trying to live outside of the need to rely upon that faith. Where do you see the role for cryptocurrency in the future because of this situation?
Well, I think there will. I'm not sure that simply because of this situation, the crypto world, exponentially grows. But I am very conscious of the fact that cryptocurrencies are growing, and over time I can only see their role increasing. However, I think again, in the very short term, you think of the last couple of weeks, and again, I cannot stress the degree of liquidation, the degree of deleveraging, the scary nature of the March crash, and of course, April has not exactly started on a solid footing either. But the one thing I would say to you, Joe, is that gold worked, Bitcoin worked, in that, if you think about them as somewhat of a store of value outside of the global international currency system, it feels as though people did say, you know what, I don't trust any of these currencies. I'm going to put a little bit of money into gold. I'm going to put a little bit of money into, to Bitcoin. But they didn't work spectacularly well, and so I think that, again, looking at the tea leaves of the market, I think what you see is people saying, I probably do want more gold in my portfolio and or more Bitcoin. I want an alternative to the regular currencies that are in there. But I don't get the feeling that this is, we'll look back on this moment and say this was the moment that crypto became, an acceptable form of exchange, driven by the coronavirus. I don't think we'll look back at this moment and say that was the case. And in fact, what I would say is that the asset that actually did work very well during the deleveraging in March was the US dollar. I mean, that was actually the safest of havens. So again, I think it's a close call between dollar, Bitcoin, and gold at this particular moment.
Michelle, we are talking a lot about the federal stimulus in terms of transfer payments, unemployment, grant programs, small business supports. Prior to all of this, there was a lot of chatter back in DC about a significant infrastructure project or package that seemed to be garnering some bipartisan support. Are we possibly going to see a return to that Roosevelt-style New Deal government spending that instead of just writing checks, actually starts doing a lot of infrastructure in future investment packages?
Sure. So I do think that we will have further stimulus. I don't think this is it. And infrastructure is on the table. It's already starting to get some traction. Pelosi was on the tapes talking about it. President Trump and his team have also spoken about it. And reportedly, it could be as big as a $2 trillion package that's being under review right now. So yeah, I do think when the government starts talking about what's the next step of stimulus, infrastructure is on the table, and it's something that has been a goal of both parties for some time, and I think understandably so. It has the most potential long-term benefits. If you can build out the infrastructure, you can improve it, you can do it efficiently, hopefully. It lends itself to productivity gains, higher potential growth, and that's something that the economy really needs right now. Because what we're facing otherwise is a lot of downward pressure on potential growth, given the potential frictions in the workforce, skill mismatch from displaced workers, balance sheet issues, credit creation issues. So the extent to which an infrastructure package is doable, I think that would be helpful. And to Michael's point, yes, the deficit is rising at a tremendous rate. Debt to GDP is very high, and it's happening globally. But this is the time to do it. When the economy, the private sector is weak, the public sector kicks in and lends a hand. The important thing will be if the government starts talking about fiscal austerity again at some appropriate time in the recovery. And I think that was where things went a bit wrong during the past recovery. You don't want to move immediately to budget constraints, right? Because then you have a Great Depression story where you're trying to balance the budget at times of need. But once you have a sufficient recovery, once things are really up and running again in the economy, then it is a question of the government pulling back. And we didn't see that in this last recovery. It's the question of whether or not that happens this time around.
I haven't been surrounded by this many Keynesians since my days in the Washington State Legislature. Michelle, I want to come back to you on the commercial real estate market. Right now, we're seeing the cascade of renters not paying their leases, and a great number, particularly in our region in the Pacific Northwest, that has a very strong commercial real estate environment, and because of that has a number of leveraged landlords because of the rising commercial real estate valuations. How are we seeing commercial mortgage lenders, banks, and others deal with leveraged landlords as their tenants are not paying?
This is a big, outstanding question. I think you have to worry about how this ends up playing out. There's a lot of leverage, there's a lot of debt, and the economics for some of these tenants might not make sense. So consider, a new normal where the economy does reopen, but there's still some threat of the virus. Presumably there would be if it's the summer. And a good portion of the workforce still has some part of working from home or more virtual working as a way of limiting how much contact people have. You don't need as many office spaces. You don't need as many malls. So I think there is, we've been shifting towards the direction of doing a lot more online, a lot more virtually. And this crisis sped that all up in a tremendous way. And I'm not sure that we go back from that. Right now, I think on the commercial estate, they're just trying to deal with the fact that so many businesses have been shut down. This is just an abrupt crisis. But once we get to the other side, how much recovery will there be for all of these different, businesses, and what would that do to the CMBS market, the commercial real estate market? I think that's a very, very important question to ask.
Well, I want to dovetail on something you said about, where are we when we come out of this? Are we still looking for high rises to put our employees in? Are we still picking up building large corporate headquarters? Michael, where do you see this leading? What are the biggest changes that will be a result of what we've gone through over the last few months and what we will probably go through over the next 6 months to a year? What are the big mammoth changes in the way that we live and work that we should expect to see coming out of this?
Well, a couple of things. I think we only have 8 minutes left, but we could do 8 hours on this particular question. But I think very obviously, and I don't want to sound corny here, but there will be a shift from emphasizing wealth to emphasizing health. I think that, the past 10 years or so, after the global financial crisis, it's been a wonderful time for owners of financial assets, but it's probably been less good a time if you're a worker in the economy. It's been good for Wall Street. It's been less good for Main Street. And I think that, Michelle was sort of touching on something with regards to malls. I think you've seen, these trends, in terms of populism, in terms of a drift from capitalism to socialism, from lower taxes to higher taxes, from deregulation to intervention in the economy. Obviously then we can go overseas and we talk about the globalization versus, nationalism or isolationism. China, which obviously for Washington State has been a big story for the past 10 years, in terms of growth and liquidity. How do we view China, going forward? So I think that, and to be honest with you, we've lived in a very deflationary era, over the past, 20 years or so, and there are some people saying kind of like, when all of this is said and done, we'll look back in 2020 and say it was, peak capitalism, it was, peak Wall Street, it was peak dollar, and maybe ultimately trough interest rates as well, that's all and then there's freedom versus surveillance and all. I mean, there's so many huge issues here, Joe, that I don't want to, I think we can only sort of just scratch the surface on some of them. But I do think that it's a wonderful question, and it is one that I can just tell everyone that's listening in on the call. Big investors are really, obviously they're obsessed with kind of like the short-term dynamics of the market and the economy, and we spoke. But what is the other side? What is the leadership in the financial markets? How socially, politically, geopolitically, economically, financially? I think things will be different in the 2020s compared, to the 2010s. Some of the changes will be good. Obviously, some of the changes perhaps will be less good.
So we are running down to just the last few minutes of our program here, but I want to sneak in a couple quick last questions to each Michael and to Michelle. Starting with you, Michelle. A lot of small business owners that are on this this webcast right now. What's the best advice for them right now, and how to survive and how to be successful in this kind of new short-term normal?
Yeah. So obviously it is industry specific, so you have to be a little bit careful. Some industries will be hit harder as a result of the containment efforts, and others could even be benefiting if you're in an industry that supports necessity. So it is industry specific. If you are vulnerable, of course, I think attempting to get funding and support from the government makes a lot of sense. So within the CARES Act, there's something called the Payroll Protection Program, which funds will start, applications start to come in on Friday. The program opens up on Friday. And I think the goal is through the banking community and through the SBA, the goal is to get those loans out as quickly as possible, with the goal of putting those towards supporting payrolls. So obviously utilizing these stimulus programs will be instrumental. We don't yet have much information on the Fed's Main Street Lending Facility program, but that could be very, very, very helpful. I mean, there's that Treasury is getting about $450 billion to the Fed for these different lending facilities. I think a lot of that will go to the Main Street program. The Fed can then lever up 10 times. So $4.5 trillion that can be filtered into the economy through credit support. So, that program probably will take a little bit longer to get up and running. The Fed is not a commercial bank. They've never attempted to do something along these lines, but they're here. They are the lender of last resort. They're the buyer of last resort, too, when you think about what they're doing on the secondary market. And they're looking to be as impactful as possible. So I think the idea is to try to utilize the Fed's, the government programs to the best abilities. I think trying to keep in touch with your workforce as well and avoid those frictions thereafter, because when the economy is allowed to open back up and doors are allowed to open and you can engage again, you need to have the workforce to do that. So I think that would be clearly very important as well. And of course, to stay healthy and to stay sane, and all that, of course, is very important.
Well, I've got about 3 minutes left, so I'm going to skip to this last question, and I'm going to briefly ask all three folks to weigh in on it. And I'm also going to ask our folks that are joining us online to ask on it. And of course, it's the question that a lot of folks want to know. We don't necessarily know what the new normal is going to be, but when could you predict, at least from a Wall Street perspective, we could see a return to our previous market highs? How long until we can see that show up on our 401ks? Mike?
Well, I think I'll take a stab at that. First of all, I would say conservatively 2022. I think that the new normal will be, and I think we'll look back on this and see an equity market that went from 666 to 3333. If you think about the S&P, which was roughly the high, and probably, the last 300, 400 points of that in hindsight was an overshoot. But I think that if you think about earnings and multiples, it's very possible that over the next 12 to 18 months, you can have an S&P 500 that inhabits the 2,600, 3,000 range. That's very plausible to me. But I think going back to the new highs, it's possible, and often these things happen a lot more quickly than you think. But I at this moment, I wouldn't bet on it happening anytime soon.
Michelle?
Sure. So that's really Michael's domain. So I think he has a really good feel for markets and for returns. So I can't weigh in on that explicitly, but I would say about the economy, when the economy returns to our pre-COVID levels, I don't really see that happening until late 2021, maybe early 2022. So pretty much in line with Michael was saying about market conditions. It will take quite a lot of time before you're able to get back to the rate of economic growth and the level of economic growth that we had pre-COVID.
I absolutely
to follow
want to thank. Oh, I'm sorry. Go ahead, Bruce.
Yeah, to follow on Michelle and Michael's comments, Michael shared with me on earlier calls that the shortest ever bear market was 62 days to go from peak to trough. And your typical bear market is 299 days. So, you're looking at somewhere between April 21st, if you look at 1987, to kind of the typical would take you to December. When we look at those typical recoveries, they're generally around 3 years. But this has just played out so bloody fast. And with all the support, it could be equally as fast. So we'll see. We'll see how this plays out in our new normal.
Well, I absolutely want to thank all three of you for joining us to have this conversation. I've been receiving a flood of comments both on our chat program as well as on text about how we wish that we could have you back every month to give us this roundup. And so imagine that there will be future invitations for that. And I hope that other folks will be willing to join as well as we continue our webcasts into the future. Our upcoming webcast tomorrow is on telework and how to manage a distributed workforce, and registrations are online. And then we've got an important webcast on cybersecurity on Tuesday morning at 9:30, where we've gathered experts to tell you about the liabilities and the best practices to ensure that you're managing your remote workforce as safely as possible. This has been a tremendous opportunity to hear from two of the biggest, best experts in the economics field that are really at the front lines of giving us the information and data we need to make decisions about where we take our businesses, small and large. I want to particularly thank Bruce, the great Bellevue board chair or Bellevue board member, and his putting this on here today. I want to thank Merrill Lynch, Bank of America, for their support in making this happen, and for all of you for joining us. Look forward to the next time that we can be together, and please go to bellevuechamber.org. We'll be launching all sorts of resources about the Protection Acts, the CARES Act, things that Michelle talked about today. We'll make sure that all those resources are out there, able for all of our members and non-members to be able to access. Thanks again so much for joining us, and stay safe.
Thanks, Joe.
Thanks, Joe.